In today's market update, we are going to take a look at the latest economic data here, including the ever-important construction industry. And while record money is come into U.S. funds last month, there is danger lurking in a category of funds. We're going to take a closer look. Let's dive in. Welcome back. I hope you had a fantastic Thanksgiving. We are now in December. It's hard to believe that. And we're ready to rock with another market update. Now, before I get into it, just a reminder to like and subscribe to the channel. Turn on notifications. That way you won't miss any of our future videos. All right, we're going to start with a fresh update on the U.S. economy. The Atlanta Fed has a tool called GDP Now that we have talked about some before. And if we put that up there, you will see that right now, the latest estimate for GDP growth, that's how fast the U.S. economy is growing, is at 3.2%. If you look at the green line there, you will notice that it is at its highest point currently today. Listen, anything above 2% is very strong. 3.2 is very, very good. And as a reference, last quarter, the economy grew at 2.8%. Now, what is driving this economic growth? We know the consumer is, and we're going to talk about that in a second. But I always like to start with a look at the construction industry, because here's the thing. This is maybe the most important sector in the economy. And when we look at that, and these are new numbers we got just in the last week, U.S. construction spending is right now at an annualized clip of 2.17 trillion. You can see that is an all-time high. This has been climbing at a nice steep pace since 2020. And this is very good news. And by the way, if we look at total employees in construction, that also is basically at a new all-time high. Now, if we break it down, we can look at the difference between the two categories, non-residential and residential. So residential, think housing, okay? Non-residential, kind of everything else, commercial buildings, etc. This goes back to 2000. You can see for most of this period of time, the blue line, non-residential, was ahead of the orange line. That changed for a little bit from 2020 to 2023. There was a significant uptick in builders building new homes because there was a rush for homes when COVID hit. So for a little while, the orange line took the lead, but of late, the non-residential category has been accelerating faster, 1.22 trillion. Residential is doing great at 945 billion as well. One of the reasons non-residential has exploded like it has been AI and data center. Anytime you hear about the cloud, and that's Amazon and Google and Microsoft, a lot of that is data centers being built, warehouses, for AI. And we have a chart here that shows construction spending on data centers themselves. And you can see from 2015 to 2022, this was growing at a measured pace. ChatGPT was launched. Everybody went all in on AI at the time, and this has exploded higher. So the bottom line here is that the construction industry is looking very strong, both on the residential side and the non-residential side. Now, our next look at the U.S. economy, we want to see the strength of the consumer. And we have talked a lot in past videos about the U.S. jobs market and how strong it has been these last couple of years, and that has powered a lot of consumer spending. We also like to look in from time to time. Bank of America releases a chart, and we're going to throw this up here, and it takes a look at their customers' total balance of their checking and savings account, and it breaks it down by their income level. So we have under 50,000 in blue, 50 to 100K in red, and 100K plus in orange there. Now, this goes back to 2019 levels. So it's saying, hey, how much money do these consumers have today versus where they were in 2019? And this graph is adjusting for inflation, which is very important. That's the green line, the dash. And so that's loss of purchasing power there from 100 to the green line of the amount of money that's in checking and savings accounts. This is a little complicated. Let's break this down of what you need to know. And that is, if you look at the far right, today, the balances in checking and savings accounts versus where consumers were 5 years ago, adjusted for inflation, all three of these groups have more money in their checking and savings accounts now than they did then. And folks on the lower income tier and the middle income tier there have more on a percentage basis than the higher income do. But the point is, when you look at this chart, is that consumers still have some extra money in checking and savings accounts, even after accounting for the fact that they've spent a lot of money these last couple of years on travel, concerts, ball games, eating out, etc. Now, one other point that I want to bring up, we have the most recent data on spending for Cyber Monday, Black Friday, this whole last time frame. And by the way, my wife contributed a lot to this, more than I wanted her to contribute, but what can we do at this point? All right, Adobe came out, they tracked this spending, Cyber Monday spending, $13.3 billion spent online, up over 7% year over year. That is an astounding jump, a growth of over 7% year over year. If you take a look at the whole 5-day period from Thanksgiving through Cyber Monday, $41 billion was spent. That is 8.2% year over year growth. Consumers spent money these last 5 days. This is good for companies that are selling their wares online. It's good for companies like Amazon and Shopify as well. It's good to see the consumer is still looking very strong. By the way, if you are not getting these kind of market updates from your advisor, go over to SentaraCapital.com and to the contact page. You can reach out to us. We have a 3-meeting process to see if we are a good fit to each other, and we would love to have a conversation with you if you're not getting these kind of updates. Now let's get back to it. All right, for our second point, we are taking a look at total dollar flows into U.S. funds. And today we're looking at ETFs, electronically traded funds. This has been where money has gone. It used to be mutual funds were a big tool that investors use, but ETFs are where it's at today. We've been using them most exclusively for 10 years. And we got recent updates on November, and we'll put this up, monthly flows into U.S. funds going back to 2020. $155 billion went into the U.S. market in November. This is an all-time record. And by the way, for the full year, it is up to $983 billion. So it's going to cross over $1 trillion coming into U.S. ETFs this year. This is good news. And listen, there are a lot of investors. We've talked about how there have been over $6 trillion of cash on the sidelines this year. Well, some of this has moved over into the markets last month. There is some hope for tax cuts and cuts in regulation and those kind of things that some investors are coming off the sidelines for, hoping those benefit businesses. Now, as an aside, I also want to look, I have a chart here going back to 2020 of funds into equity funds into the U.S. stock market versus the rest of the world, Europe, Japan, emerging markets, etc. And you can see that of late, the big move higher in U.S. funds that we just talked about. Meanwhile, there has been a downtick, money leaving international stocks. Now, part of the reason for this is that international stocks have been woeful performers over the last 5 years, over the last 10 years, etc. We have ignored the international markets and been exclusive for our clients, and that has worked out very well. Doesn't mean it's always going to be that way, but so far, that's the scorecard on flows into the U.S. market. Now, the next topic here is going to be on fund flows, but we're also going to look at what ETFs are money going into. And we're going to talk about something we haven't talked about before. Thematic ETFs. So a lot of times when there is a part of the market that investors start to get very excited about, financial companies say, let's create a fund and invest in companies in this space. And often when they do, money comes pouring in. But there can be serious danger lurking at buying into these ETFs, these thematic ETFs. We're going to put up a chart of the last 5 years of the performance of the U.S. stock market, the S&P 500. You can see it's in purple at the top, up 79% over the last 5 years, done very well. But look at the rest of these categories. Cannabis. Look, there was a period of 1 or 2 years where cannabis stocks, weed stocks, were a major rage. It was talked about all over the place as, hey, this is a can't miss area. This is down 81% over the last 5 years. Next, sports betting and iGaming, up 2.5%. Solar ETF down 34%. Lithium and battery technology, EV was very popular 3 or 4 years ago, up 15%. Genome revolution, companies that do gene editing and such, down 56%. And last but not least, the ARK Innovation ETF down 37%. ARK Innovation, Cathie Wood, this was a fund that exploded and was up, I think, over 100% back in 2020 or 2021 and had billions flow into it. It has not done well since. And to go a step further, because listen, that's the performance over the last 5 years. But we have to look at where are these funds now compared to where they were at their high? Because a lot of times money comes in at the highs into these funds where there's a lot of mania and excitement. The S&P 500, where is it today versus all-time high? At 0 because it's at an all-time high, okay? But look at these other numbers. The cannabis fund down almost 92% from its high in the last 5 years. Sports betting down 37%. The solar ETF down 69%. Lithium and battery technology down 51%, the Genome Fund down 76%, and Cathie Wood's fund, which I believe was the largest of any of these at its peak, down almost 62%. So if you got swept into the excitement around some of these areas, you have lost a lot of money from where these were at their peak versus the U.S. equity market. Now listen, this would have also looked like this back in 99, 2000 around internet stocks. And listen, the internet went on to be far bigger than anyone could have imagined at that point, and many companies far more profitable than they would have been at that point. So it doesn't mean that in the long run, some of these companies may end up being good companies, but when they're in their infancy and there's a lot of excitement and mania, this is something that says buyer beware. Okay, so to recap, we looked at the most recent projection for growth in the U.S. economy in the fourth quarter, very strong at 3.2%, and we saw it's being powered in part by construction spending, very good, residential and non-residential, and we looked at the U.S. consumer still looking very good with their balances in their checking and savings account, and they spent a lot of money during the Cyber Week. We also took a look at flows into U.S. stock market. 155 billion into US ETFs, an all-time record in the month of November. And while that's great, danger can be lurking if you get swept up in the excitement around a specific theme, and thematic ETFs come along at just the wrong time. You have to be very careful there. Thanks for watching and take care.